Alright guys, so in this video we're going to be going over ranges. So, ranges. What are ranges? Ranges is simply whenever price goes and makes a high, comes down and makes a low, and then price goes back to this high right here, but say instead of breaking it to the upside, instead what price does is price will come up to this high, then it will start falling away from it, and it'll come down back to the previous low, and then instead of breaking that low right there, price will actually reject it, come back up to the previous high, and then instead of breaking that high right there, price will actually instead fall away from it right here, and then it'll come back to the low and it'll bounce around and it'll just go sideways. This right here is what characterizes a range. When price is failing to make new highs and price is failing to make new lows, price is typically in a range. Now, you can call this a couple things. You can call it the market's in a range. You can call it the market is in consolidation. You can say the market is going sideways. You can say the market is not in a trend. You can say the market has no clear direction. And you can say the market's being pretty stupid. Because if the market's doing this right here, then it is not a good time to trade. And let me explain why. So, if we're trying to capitalize off of the market making a movement, and we're really trying to catch a good chunk of the movement and a good sized movement within the market, the easiest way to catch a movement within a market is whenever a market is in a clear direction. That's when the market's clearly pushing upwards or clearly pushing downwards. That's when the market is just popping. It's got like a bunch of action going on. So even though the price may be going sideways and you can catch the direction, maybe if you sell right here or if you maybe buy right here and try to profit off the market going up, you're doing it at the risk of price breaking out at some point, because the market will not stay in a range forever. Whether it's in a range for a day, a week, a month, a year, the market will eventually get out of this range. And once it gets out of this range, it may test the previous highs as support, and then it may start taking off into a new uptrend, at which point then you could look to trade. But until that happens, you don't know when it's going to break out. And so there are some people that will say like, yeah, you can trade the ranges and you can make some money. I am under the 100% conviction that you're going to be more profitable if you just focus on trends instead of ever trying to mess with the market when it's in a range, whenever it's in consolidation, whenever it's going sideways. So that being said, what is a good thing to look for in the market? Just like I was saying in the first example, is that the thing that you want to look for is the market in a clear direction, and that's why we want to avoid ranges, because in a clear direction, look how much easier it is. The market, if it's clearly going up, it's cracking previous highs, it's coming and testing those highs as support and it's bouncing. And it's cracking the next set of highs right here, coming back to test that area as support. And it's going up and it's finding its previous high. And it's going right here and then it breaks above. So then it comes back and tests this area as support. It's going an uptrend, maybe it does something weird like that, but then it moves right back up and then continues going up in the uptrend. You're going to be so much safer just looking for buys along this uptrend area than you would be looking for sells for one, and then on top of that you're going to be safer than if you were trying to trade a range. When the market is in a clear direction, you got to understand, it's like you're in a river. Let me just do a next slide for this. Let's say you're in a river and the direction of the river is this way, and let's say if you jump in a river to have it take you somewhere, well, there's two things that you don't want. The first thing is that if you're trying to go that way and you're standing here and here's like the little side of the river and this is the water right here, if you want to go that way and you jump in this river, if you just jump in and don't do anything, then you're going to get hauled that way, which is, it's counterintuitive, because if you're trying to go this way, you don't want to be going that way, so it's just stupid. So you don't want the river going against you. And also on top of that, if you want to go that way and you jump in the river and then start swimming this way, the current of the river is going to be pushing you that way, and so you're going to have to be a very strong swimmer just to be able to remain in the same damn spot. And then on top of that, you're going to have to be even stronger to fight the current to try to still go in that direction. Whereas if you're trying to go this way, over this way, but the river is going over here to the right, you're going to be better off just staying out of the river and probably just walking along the bank of the river if you really want to go that way. And so if the market is right here and it's not going the direction you want, which is, like in a sideways range, just stay out of the market. Because what you want is, if you're in a river, let me take my 10-year-old drawing off, and the river's flowing that way, and you want to go that way, then it's going to be a really good idea as long as you're, a decent swimmer and the river is not raging or anything wild like that. Under normal conditions, with just like a gently moving river going that way, if you jump in the river, for one, you're going to start moving in the direction you want to go, which is good. And then on top of that, the current of the river is going to push you. And then, so while you swim, it's going to be even easier for you to go because you're going to be moving even faster if you're swimming this direction and the river's pushing you that direction and you want to go that direction. It's just like a win-win-win. So the idea behind this is like, don't jump inside of a market whenever it is in a consolidating range. Because when the market is in a consolidation and it's just going sideways, and you can get this based off the H4 or the daily chart. If it's just going sideways, if you pull up a chart on the daily or the H4 and the market just looks like it's going sideways and it's not in a clear direction, the best thing you could do in your life is just to stay out of the trade and don't trade it. So you've learned the conceptual part of it right here. Let's just go and look at a quick example in the market. Since this is so easy, I'm not going to take a lot of time on it, but let's look at this right here. So if I had to have pulled up this 4-hour chart on gold, you see how gold, it came up here and it made this high, came down here and it made a low, popped up to this previous high again, rejected, went to that previous high again, rejected, came down here and made a low, then bounced up, and then a low, and then bounced up, then a low, and then bounced up, then a high, and then rejected here, and then a low, and it bounced up. So the fact that the market is bouncing at all of these previous lows in here, that one, that one, that one, this one right here, the fact the market's rejecting there and also along these previous highs, like right here, right here, right here, right here, the market keeps rejecting these areas. It's really hard for us to try to identify any really good trades because there's no clear direction at that time. Now, of course, you could start looking at smaller term stuff like that, like having to zoom in, and then you can, then you're looking at smaller term stuff like that and just a bunch of stuff. But remember, whenever we're trading, just like you've learned in the previous videos, to identify the overall direction, you want to go to the bigger time frame. And the bigger time frame right here, for the time being, the gold was in a downtrend. And then on top of that, if we scroll out even more, you can see that gold is in an uptrend. However, the more important information would be what the market is currently doing. There's no specific amount of like time frames that you have to scroll back on, like 2 years worth of data, or maybe like 1 year worth of data, which is what this would be like right here, like from here to here is 1 year worth of data, or maybe it's this much data, like from August, so a couple months ago up until now. There's no specific way to do it, but remember, like if you're zooming out like that far on the daily and you're looking at stuff from like 2015, which at this time it's almost 5 years ago, you're going to be better off looking at what's going on most recently. Yes, you want to use the daily and 4-hour chart, but while you're on the daily and 4-hour chart, you want to make sure that price is not in a range. You want to make sure it's in a clear direction before you're looking to trade. So that being said, that is ranges. Let's see if we can find another example of this. New Zealand dollar JPY. Would you say New Zealand dollar JPY is in a clear direction? If you're looking at this chart right now, is it going downwards? Is it going sideways? Or is it clearly going up? If you said up, 2 gold stickers for you. You are learning. Because yes, the market is in an uptrend right now. It's not in a range. So it'd be a good idea to trade. And we would only be looking for buys if the direction is clearly up. Under no circumstance would you look to sell anytime soon until the market starts doing stuff like this. Like where you can clearly connect the highs on the daily or the hour 4 chart. And you can say like, the market's sort of going in a downtrend and it's just moving downwards. Then at that point, yes, you can look for sells. So that being said, that's it. It's just literally that simple. Whenever the market appears to be going sideways, do not trade it. On the daily and the H4 chart, and primarily the H4, since you'll be making a lot of trading decisions off the H4 chart. Look at the H4. If the market appears to be going sideways and not making new highs and new lows, don't trade for the time being. Go to another pair where it's easy to see like, oh my god, it's in a clear trend. Go to another pair. Only trade when the market is moving upwards, and only trade when the market is moving downwards. Do not enter positions when the market appears to be consolidating inside a range. So that's it. See you in the next video.